Whole life insurance is a wildly misunderstood product. It's one of those products that you either love or hate. People like Dave Ramsey and Suze Orman swear that whole life insurance is the worst financial product on the face of the earth, while at the same time, some of the most successful financial stories in American history, like the creation of Disney and McDonald's, for example, are only able to occur because Walt Disney and Ray Kroc used whole life insurance as a storage vehicle for their cash. However, I'll say this. It's not all rainbows, unicorns, and glitter when it comes to whole life insurance. And as much as I love whole life when it's designed the correct way and utilized to fulfill the proper function in your personal finances, there are a lot of downsides that you have to avoid. And at the end of the day, these are the downsides that the likes of Dave and Susie are trying to protect people against. And from that perspective, I get it. I'd have to agree with Dave and Susie. The good news is that all the downsides are completely avoidable, and if you work with the right life insurance professional who understands your goals, your wants, needs, and objectives, properly designed whole life insurance policy can be one of the most powerful assets in your life. Now you're probably thinking to yourself, Chris, that's a pretty bold statement, and to that thought, I would agree. It is a bold statement, but it's a bold statement that I'm willing to stand behind. Let me explain. If you watch the Life 180 YouTube channel at all, you know that I talk a lot about whole life insurance because I love it so much. But you also know that I'm not a huge fan of actually pushing financial products. The reality is, the reason I love whole life insurance so much is simply because when we get away from the product names, the investment strategies, the talking heads, including myself, all that matters is your goals, your values, and your beliefs. So, in the interest of keeping this as straightforward as possible, I'm going to focus more on the attributes of the policy. Let's not talk about whole life insurance. Let's talk about you. Your values, your beliefs, your goals. What do you want to happen in your life, and how do you align your money with your values and beliefs to help you accomplish those goals and objectives with more certainty? So whole life insurance has three components to it that matter the most to people. There's a death benefit, there's cash value access like a banking and savings alternative, and then there's living benefits through the accelerated death benefit riders, and I'll get into all this stuff. So let's go through those three components in order, breaking down how they can all impact your financial life and your family's finances for potentially generations to come. When most people think about any type of life insurance, the natural place to start is obviously death benefit. In fact, I think most people actually think about life insurance as death insurance. But the reality is there's so much more to whole life insurance than the actual death benefit. I'll get into that soon, but for now, let's talk about the different elements of a whole life insurance policy that impact the death benefit. Now, there are four components that impact the death benefit of your whole life insurance policy. Your health and age is first. Your base premium of your whole life insurance is the second. The third is your paid up additions, and the fourth is your term insurance riders that you add to the policy. Now, of course, your health is the foundation of everything. I always tell people that owning a whole life insurance policy is a privilege. It's not promised to you. You need to qualify for it. And even if you do qualify for the life insurance, there are ratings that exist to determine your cost of insurance. You could be rated from preferred plus, preferred, standard, substandard. There's a whole table rating system. You could get a smoker rating. Ratings are all over the map, and you have to go through the process to see what you are approved for to see how it works for you. Remember, insurance is about managing risk. The healthier you are, the lower the cost. It is absolutely essential that the life insurance company understands your health and the potential risks so they can assign a rating to you. That rating, along with your age, is going to help determine the cost of insurance. Now, there are several ways that you can come to a death benefit calculation. The traditional way of selling whole life insurance is to determine the death benefit desire and then determine the premium based on the life insurance amount that you're asking for. This is the way of designing life insurance that makes Dave Ramsey's head want to explode. When you use 100% base premium option on a whole life insurance policy, the costs are pretty high. And while using the base whole life policy can make sense for some people, it's really a small percentage of people, i.e. the higher net worth segment, that would use this strategy for legacy and tax planning for the next generation. So, what should be included in your life insurance policy? In reality, every whole life insurance policy should have a blend of these three things. First, your base whole life insurance premium. Second, your paid up additions. And third, your term insurance rider. There are other things that you can add like guaranteed insurability riders, which I love for kids policies, and waiver of premium riders, but I'm not gonna focus on these right now. We're gonna just stick to the basics. And now that you know the 3 components that you need to be included in every whole life insurance policy, now it's important to understand how to determine the premium payment. This is where it gets tricky, and I have a lot of videos talking about this topic because it's more complex than one would think. To keep it simple, just start with a dollar amount that you can save every single month. Pick a dollar amount that stretches you and forces you to save, but not so much that it's gonna stress you out completely. It's my belief that any money you keep in a long-term savings account for emergencies or opportunities would be more efficiently saved inside of a whole life insurance policy, and you're gonna understand why soon. My overriding belief is that people should keep 2 years of income in guaranteed liquid assets in case of emergency or opportunity. 1 year of income for emergencies and 1 year of income for opportunity planning. So if you make $50,000 per year, the goal is to get $100,000 into a guaranteed financial vehicle, of which my preferred financial vehicle is obviously a whole life insurance policy. So let's say your goal is to have that $100,000 in the next 10 years. That means you're gonna be saving about $10,000 per year to get there. Assuming the $10,000 per year in premium, now we need to determine the blend of base insurance, paid up additions, and term insurance used for that $10,000. One of the things I always tell people is that there are no free lunches with life insurance. It is always a give and a take. The higher your base insurance, the lower your liquidity or cash value access will be in the first several years. This is obviously a big deal if you're needing that money for emergencies. The lower the base and the higher the paid up additions in the policy, the more early liquidity you have. However, the long-term growth will typically be reduced by a little bit. In addition, the higher blend of paid up additions you use, the larger the term insurance rider that you'll need to be able to use in the contract to be able to keep it from becoming a modified endowment contract. And that term insurance rider comes at a cost, which creates a drag on the efficiency of the policy. What is a MEC, you ask? Well, it's a modified endowment contract. It's a formula that the government created back in the early 80s when they created qualified plans like the 401k. Essentially, before they created the MEC rules, you could jam as much money into a life insurance policy and keep all of the tax-free benefits that you wanted. But when they created qualified plans, they knew they had to limit the tax benefits of products like life insurance. Otherwise, you'd never put your money into their 401ks. Now, when you hear somebody talk about max funding a whole life insurance policy, what they're really saying is that they're funding it up to the MEC limit to keep the tax benefits. Now, I'm a big believer that if the government is trying to limit your ability to contribute to something, there must be a reason. And that reason typically isn't for your benefit, it's for theirs. So I'm gonna max that out and fund it up to the dollar anytime I can. So what we do here at Life 180 is we create our own MEC, what we call a maximum efficient contract. It's the perfect blend of base premium, paid up additions, and term insurance to focus on cash efficiency in the policy to match your goals and your time frames. While I think every whole life insurance policy should be designed for the maximum cash efficiency, I also believe that we shouldn't dismiss the importance of having the amount of life insurance that your family needs. But be sure to supplement the amount of insurance desire that you have with a good convertible term insurance policy, which is gonna keep your cost of insurance down and the expenses in the whole life insurance policy as low as possible, increasing the efficiency of the cash. So people ask about what is the perfect whole life policy design? Well, I have news for you. This doesn't exist. Life doesn't exist on a spreadsheet. Life happens out there in the world. And I don't believe that whole life insurance is a product that should be sold on a spreadsheet, because if that's what you're doing, you're likely not considering all the other variables that should be taken into consideration. There's some people that swear that the only way to design a policy is with a 40-60 blend, which means there's 40% of the base whole life insurance policy, 60% goes into paid up additions. When you design a policy like that, the insurance company is going to determine automatically how much term insurance is going to be needed to allow those paid up additions to be added without the policy meching. Nelson Nash actually made the 40-60 blend extremely popular with his infinite banking concept and when he wrote the Becoming Your Own Banker book. Other people are going to sell you on the fact that a 1090 policy is the best way, with 10% base insurance and 90% paid up additions. And of course, on the other far side of the spectrum, there are purists that believe that 100% base policy is always the best way to go. Now, I have many videos breaking down all of these different concepts, all these different blends. So to keep this video straightforward, I'm just gonna tell you what I believe. I believe that the best policy design for you is the policy design that meets your goals and objectives. Each person has their own unique personal finance ecosystem. Each person has their own priorities. In order for you to know which design is best for you, it's essential that you're 100% clear on your values and your beliefs. Then you can reverse engineer a financial strategy that's congruent with those values and beliefs. You can't spreadsheet this stuff until you are clear on that. It's called whole life insurance because as long as you pay the premium, the benefit of having this policy will be with you for your entire life. And it's not just about the death benefit. The living benefits are just as important to most people, if not more important. Let me elaborate. As we go through life, our needs change. When we're young, we need to save money and build our financial foundation for the future. I talk about this a lot in my Life 180 Pyramid Talk. Then we get married and we have kids. Life becomes a little more complicated with more responsibilities. Our needs and our wants change as we grow our families. Then comes retirement, and ultimately, there's no getting out of this thing alive. What I've seen is that for anybody that thinks truly long-term, whole life insurance becomes an absolute no-brainer because it helps you in every stage of your life. Let me elaborate briefly. In your 20s, before you have a family, it's important that you save money. Well, whole life insurance is the best forced savings vehicle on the planet. It builds in a self-discipline plan for you when you are probably at the least disciplined age of your life in your 20s. Long-term, whole life insurance will outperform your savings account, CDs, and bonds. At the same time, you'll have a very high percentage of liquidity if you follow my advice from earlier on how to design it. The amazing thing about this is that you typically are never healthier than you are in your 20s, right? And unfortunately, you're also never going to be younger. That accomplishes one amazing thing, which is cheap insurance. By getting ahead of your insurance wants in your 20s, or by doing this for your kids if you have the resources to do so, you're checking several lifetime financial needs off your box. You'll have your emergency and opportunity savings fund built, and you'll also have life insurance to protect your family. Now, of course, there's obviously a high likelihood that you don't have a family yet if you're in your 20s still, but you probably will have one at some point in time if you're like most people. So why not guarantee their quality of life before they are even here? It's more efficient than saving in a bank, and it'll save you money on insurance since you're buying it a decade sooner than you would otherwise. It's just good planning, and it's the number one thing I wish somebody had taught me when I was in my 20s. Now let's take it to the next level. You then get married and you actually start having a family. You have different focuses now. Financial stress of the kids, saving for college, investing for your retirement, and so much more. The good news is that having your policy in place for a decade at this point, or even if you're just starting one, will put you in a far better position. Any cash value that you have in your whole life policy can be used for emergencies, of course, but the part I love most is what I call cash flow hacking, which is the process of using the cash value in your whole life insurance policy to invest in cash flowing assets like real estate. It's not for everybody, but for people who have a leaning towards entrepreneurship and real estate investing, there isn't a more powerful product in the world than a properly designed and mature whole life insurance policy. Now, as you hit your 40s and your 50s and your kids head off to college, hopefully you've saved as much for college in your whole life insurance policy as possible. In fact, ideally, you would have gotten your children their own whole life insurance policies to save in. A properly designed policy is a great alternative to a 529 college savings plan. In most situations, the amount of money in your whole life insurance policy is not used against you when calculating for your expected family contribution, which is basically what's going to determine how much money you have to come out of pocket to pay for college. That's a huge deal if you haven't had to deal with it yet. And if you have had to deal with it, you know exactly what I'm talking about. Then comes retirement, which is a word that I absolutely despise. In fact, I'm on a mission right now to get people to stop using that word and just create enough cash flow to be free so you can show up as the highest version of yourself in the world. While that's a battle that I'm willing to fight, I know that I can't save everybody. Either way, as we age, we do become more vulnerable to health issues. There's just no getting around it. Did you know that medical bills are the leading cause of bankruptcy and financial struggle in retirement? Did you know that you have over a 70% chance of needing assisted living before you die? Did you know that most people don't think about these realities to try to deal with these facts until it's too late? Long-term care insurance is extremely expensive, especially if you wait until your 50s to address it. Remember I said earlier that whole life insurance is going to help you through every phase of life? Check this out. If you get the right type of whole life insurance policy, it will come with the ability to accelerate a portion of your death benefit to cover medical treatments and bills if you're diagnosed with a chronic or terminal illness. This money can be used to pay for assisted living, long-term care, or other medical treatments. This topic is something that in the past I always downplayed. After all, I'm just human, and while I was in my 30s, I really couldn't grasp the reality of health issues later in life. Then my father-in-law a couple years ago was diagnosed with pancreatic cancer and given 90 days to live. I can remember the oncologist telling him that they could probably get him to a year, but that his quality of life would be absolutely horrendous. Long story short, and we decided to go the more natural route with alternative treatments. Treatments that insurance companies wouldn't pay for. Treatments that cost over 6 figures out of pocket. I can tell you some good news is that 2 years later, my father-in-law is still playing golf 3 to 4 times a week and able to hang out with his 3 grandkids virtually every single week. The tough part is that most people haven't been proactive enough, haven't thought far enough in advance, and don't have the proper planning or resources to come out of pocket for 6 figures of medical expenses to fight for their life if they need to. If you have a properly designed whole life insurance policy as part of your financial plan, it changes all of that. Then, of course, as we pass on to the next life, the one thing that every personal finance expert can agree on is that there is no more efficient way to pass money to the next generation than through life insurance. It's for all these reasons that I tell my clients that having whole life insurance as the foundation of your financial life is the only way to create what I call a self-completing plan. What you want to happen will happen when you want it to happen, even if you're not here to see it. When you think about what you want in life, when you contemplate how you will feel on your deathbed, thoughts about your family, your relationships, your legacy, how you showed up in this life, and much, much more. If you close your eyes and you visualize your life, how you lived, what you created, and how you want to be remembered, can you think of another product that's going to help you in a fraction of the amount of ways that whole life insurance did? I would venture to say no, and that's why I'm so passionate about this product and educating as many people about it as possible. I hope you found value in this video, and I hope it opened your eyes to just think a little bit differently about money and your long-term planning. Have a blessed, inspirational day. We'll talk soon.